I think one of the most challenging things about crypto from a mental model standpoint is we are combining the mental models of public market investing, where companies are primarily in their later stage by the time you've gone public, versus very early stage investing. And so one thing that I feel like I have consistently seen is this idea of, hey, we have these publicly traded tokens. We can take these mental models and frameworks that we have from investing in public market and apply them. And I don't think that that maps one to one. I think that there's the life cycle of capital investment and, return on invested capital that you want to see before capital is handed back to shareholders and the company statistically dies. And so I think that the reason, just because there is a reward for buybacks in public markets, which empirically exists, does not mean, I don't think, that you can copy that one to one on early stage private markets.
This episode is sponsored by Canton, the only public permissionless blockchain built for institutional finance. We'll hear more from Canton later in the episode. Blockworks Digital Asset Summit is back in New York, March 24th through 26th. We'll have top speakers from leading asset managers, financial institutions, DeFi protocols, crypto companies, and policymakers all under one roof. Think BlackRock, Coinbase, Robinhood, and more. Follow the link in today's show notes to buy tickets and make sure to use code BELL200 for $200 off at checkout. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed.
All right, everyone, welcome back to another episode of Bell Curve. You got all the fellas here. Myles, Xavier, me.
Good to be back.
Good morning.
Oh, it's a good morning. We did our bear market episode, so I guess we've established that we're in one of those. So someone has to restart the DGen Spartan bear market tracker. I don't know if you guys ever remember that.
What happened to that guy? Just signed off. I respect it,
He
actually.
quit last cycle, didn't he?
Yeah, I think that's right. Yeah.
He was very bullish on Lido and Coinbase. So I think he put half of his net worth into each, and it just kind of leveled out. They each canceled the other one out, and he just I think rode off into the sunset. At least he lose money. I don't know. All right.
Feel his pain.
So we're going to be talking about, we actually had the idea of this episode was to talk about buybacks, but we wanted to make it more expansive. And we had the idea of making this actually about what makes for a good token. And so that's encompassing of what are the different types of tokens that exist. That is, how should you think about, valuation? We are going to talk about buybacks and value accrual as well. So we're going to tackle hopefully all of these subjects. But before we get there, I just want to do a quick shameless shill here. We've got Digital Asset Summit coming up. Both of you guys are going to be there. We're going to be doing live bell curve related topics. So there's a discount for all you lucky listeners, Bell 200. You do have $200 off. But yeah, we got chairman of the SEC and the CFTC both there. We got the CEO of Western Union. We got the CEO of Binance there. We've got Stephen Moran, who sits on the Fed board of governors. So it's gonna be a very institutional event, very good. And then we've got all of your favorites, the Athenas, the Sparks, the Aves. Stani's gonna be making an appearance. It's gonna be really good. And of course, Myles and Xavier. So that's that.
Must be really fun to track the history of DAS, because it was always the institutional event, right? And it always felt like kind of these guys were so far away from the action, not years away from actually doing anything, and just kind of observing and sharing thoughts on where this could go. And now they're they're actually on the playing field, right? And so yeah, I'm very curious to hear the difference between what the stuff we hear this year versus even 2 or 3 years ago. But it'll be a lot of fun. Come ask questions or heckle us or grab a beer.
Yeah, no, it's my first event for the year, so I've been saving it for this one. So looking forward to being back in New York with everyone, and yeah, looking forward to an epic event.
You know what? It's fun. What DAS used to be when we did it in 2019 was basically going to the one, like 25-year-old guy who works at JP Morgan is like, no, guys, this is super serious. Like, please, it was like, hear from him. But now those people are running teams, and actually, there's chairman of the SEC and CFTC who actually, they're teaming up for Project Crypto and doing real stuff. So it is, this moment in time is interesting too because we're talking about this bear market. If you were to talk to institutions, actual banks, big asset managers, fintechs, completely different vibe for them. So it's biggest divergence, and it just keeps getting bigger and bigger. So I don't really know what that means, but
But it's good. I mean, it means that we're maturing because, like, do you remember the amount of institutional interest would always basically be correlated to the price of, tokens, right? And whenever like we started a bull market, it was like, oh, they love crypto. And then we wouldn't hear from them for years, in a bear market, right? And now they're, building products that are not just predicated on selling these tokens or allowing people to access to these tokens. They're actually using the chains. And so, the interest is much less like volatile and stickier, which is great.
Yeah, I think as well, like it's a great time to understand that market, the institutional market, like what are they actually using and paying for? I think still the crypto native crowd sort of assumes some things that they're using and paying for without actually knowing exactly where the flows are happening on chain. So that's what I'm personally the most interested to learn more about at the event.
so maybe to build on both of those ideas and segue into our topic of the day, I I think it would be interesting to, talking about questioning assumptions that we've had for a long time in the industry. When we talk about what makes a good token, before we get to the buyback debate and the value capture versus value accrual, discussion that I'm sure everyone's heard quite a bit, that would just be interesting to start with a taxonomy of the different types of tokens that exist, um, and historically how we've defined that, and then question if it's really quite as expansive and broad as you know as the classifications that exist today. So, if you were to look at the different types of tokens that exist, there are stable coins, which I think we all know what those are. Gas or network tokens. So this is like ETH, Sol, AVAX, which are actually required to use the network. Governance tokens. So these are like the through line for all of these tokens is the label is how their value is derived, right? Like that's the utility function supposedly of the token. So for a network or a gas token, you need to hold this. And so there's kind of this like latent, there's this, demand or bid, kind of like an industrial commodity or something like that. Utility tokens, you unlock specific product features like BNB or Link are good examples. So basically they have a bunch of, and this is kind of the Chuck E. Cheese analogy, if people remember this from 2017, which is, we're not pre-funding a company, we're selling Chuck E. Cheese, tokens. So that's hilarious that we literally call these things Chuck E. Cheese tokens. They're revenue sharing or dividend tokens. So obviously not exactly like this, but this is our tokens that give you a claim on cash flows, right? So this would be the most equity like construction or a way of viewing a token, and maybe you get that paid back in burn or buyback. And then meme coins, which are just pure social consensus and narrative, no cash flows. So Bitcoin, edgy. This podcast, it's an edgy podcast. But those are the categories. I'm curious, when you guys look at this category list in the cold light of day in 2026, what do you think? Do all of these need to exist? Should they exist? What do you think about this?
I don't think it. My initial reaction when I read, I was like thinking about this is that this is really no longer relevant, like, or nearly as relevant as it used to be. I think back in like, the early stages of, I don't know, 2018 to 2022, like there was so much more like wonkiness in terms of value accrual, governance, and all of these things, and regulatory, like just noise. And we had to make up all these new like sort of concepts. And now I think in reality, like there's not the framework through which investors evaluate something like an L1 token is not that different than the framework through which they evaluate, let's say an app token. Like there's value accrual tied to usage of the product, and that product can either be a development platform or it can be an app on those development platforms, right? And there's like so many considerations that go into like, okay, is that going to grow in the future, and what multiple should be assigned to like the current level of value accrual, right? And yeah, there's like nuances that we can get into between like the, L1s versus app tokens, but I don't think it's that different, right? I think it's basically at this point, like we're not making up new frameworks. We don't need like, we basically just map over how we evaluate equities to these projects, or how you evaluate, startups to these projects. And that's it. Like, I don't think there was a good argument for like a commodity based valuation for L1 tokens a while ago. And that maybe is the only thing that I think still like holds as, okay, maybe we shouldn't just look at all of these like equities, but yeah, Xavier, go for it.
Yeah, I think maybe just a comment around the evolution of some of these types of tokens where let's say 4 or 5 years ago, way before regulation was introduced, you had a lot more governance tokens, especially in DeFi. And DeFi historically has been one of the categories in crypto which has actually generated a lot of value, and also been something that people want to get involved with. Back in the day, there was a kind of narrative sold to holders of the tokens that they would have a role to play in governing the treasury of some of these protocols that lived on chain. For example, like Uniswap, Lido, also Compound. In general, post regulation, as a lot of us are aware, we've moved more towards kind of like buybacks slash revenue sharing. I know a lot of us try to avoid the word dividend, but there's a lot of different ways to spin what that actually means. And so you don't really see as many governance tokens anymore. Utility tokens, when I entered the space, this was a really massive topic for tokens, and probably most actually tokens were utility tokens, like paying for different things to use the network, for example, with Chainlink for, to pay for Oracle payments. These days as well, post regulation, even things like utility tokens are moving more towards kind of like just paying in USD, no longer paying in the token. And I think a lot of this is because of the regulatory climate. So I guess like the big question is right now, how pro is the current regulatory climate, especially in US, to buy back tokens, to give value back to token holders? Or is there still a risk really where some tokens are still avoiding paying back some of the sort of value they're accruing to their treasury and the protocol? And I think Lido is a great example here, which I'm sure we're going to dive into deeper later in this podcast.
I guess the one thing I would push back on is that there's any difference between a governance token and like a revenue sharing or dividend token, at least looking forward to the next 10 years. Like whether or not that value, is accrued to a treasury and then reinvested to pay like into growth or to pay for operational expenses, or whether or not they just, decide to allocate that capital back to token holders is just it's a management decision, right? And I do think that like is increasingly going to be like, kind of the status quo, which is great. Having governance tokens that accrued no value was, only rational if there was a reason for them not accruing value, like the reason that Facebook didn't charge early in the days, of its growth. So that's my one pushback on I think this delineation is kind of like a thing of the past, and that's a good.
Before we get back into the episode, here's a quick word from our sponsor, Canton, the only public permissionless blockchain built for institutional finance.
TradFi wasn't built for 24/7 markets. DeFi wasn't built for regulated institutions. But Canton is where the power of finance meets the promise of blockchain. The only public blockchain with institutional-grade privacy, true composability, real assets, real markets. Why reinvent finance when Canton makes it work the way it should? Canton, where finance flows.
Can I so I think there's also to draw the through line of this whole episode where we say, what do we mean when we say what makes a good token? I think the answer to that probably is that it has to go up. And I think that people have looked for different ways to accomplish that in a way which doesn't get them arrested. And here are actually two different forces that I think have confused people. And if you guys know, the three body problem, the idea that there are three bodies of mass in space and two bodies you can kind of predict where exactly they're going to be. But as soon as you introduce a third, it gets all complex and wound up and you can't understand at any given point if you turn the crank where one body's going to be relative to another. Here are the three bodies, right? There's a valuation methodology. There is something genuinely net new in the form of Bitcoin. So I think Bitcoin was we've talked about this on the open source episode. I actually would put L1s as a net new thing that didn't exist before this. And then there is regulation and there is what can we say, right? So all of these three things interacted with each other and you got these constructions like a utility token, and you got a governance token. And the governance thing is kind of related to how value gets created in equities. And these things just got all so tangled up that it's very difficult to rewind the clock and understand, do we think this way because we're copying Bitcoin? Do we think this way because we are trying to get a certain regulatory treatment? And infinite combinations of all of these things. And I think personally, what I would boil this down to, the way that I would explain this is that, and actually the SEC has been saying this, is that what I don't think we've done is really invent anything on crypto rails is just a wrapper for an asset that exists. And I think mostly you can bucket these things into, this is a commodity and this is how we look at and value commodities. This is an equity and this is how we look at and value equities. And I think the regulators are saying that, and I think that's very reasonable and fair. So that's my explanation for why utility we got all wrapped around the axle because of these, a net new invention, but then people having to speak out of two sides of their mouth.
Yeah.
I still think we're in a bit of an awkward phase though, because not all utility tokens and governance tokens have moved towards this kind of like revenue sharing token model. And so I think a lot of that is still because it's still not 100% clear, I guess, what this regime looks like long term. And again, want to take it back to Lido, where like this is a good business, like earning a lot of revenue per year and, potentially growing that over time. And the token is down like, I don't know, maybe 80 or 90% from all-time highs. And I think if I think back to pre-regulation, why people held these tokens in the first place, like, governance tokens have been called kind of useless by many people over time. But I think a lot of people held these tokens with the thinking that in a more regulatory favorable environment, they'd actually have a claim on future cash flows. But you're seeing now, even in this environment, some tokens aren't allowing holders to have a claim on those cash flows. And I think they're being punished. And I think the financial markets are really rewarding tokens that are being bought back. For example, Hyperliquid. There's a big outstanding question there around like, when do you buy back the token? And I think because this is a new era for crypto of like having even the opportunity to do that in the first place without feeling like you'll be subpoenas. I think this is interesting to explore in terms of like, what is actually working right now in crypto? Does it work at all? I know all of us here have differing opinions on buybacks, but it's certainly the thing being rewarded the most right now in financial markets. And it's also a big trend right now in the space to be doing this and move away from utility tokens and governance tokens.
Right. I think like the value capture and then value like distribution to token holders, like that goes back to like a trust problem that was, like the trust between token holders and protocols has been broken so many times, right? When it really should just be more like, public equities where it's a capital allocation question. Like there is, if token holders like by default have rights to the, over the cash flow created by like by the product or by the protocol or by the company, then it's just a question of, okay, for every dollar that we get in, do we think we can reinvest that into growth that creates $2 of future revenue in the future, right? And that versus like, do we think it's more valuable to either distribute a dividend right now or to buy back our own token because we think it's undervalued, right? So we're going through this weird like period where we have to reestablish trust. We have to get clarity on like what rights token holders actually have. And then there will be so much less noise in this, question of like, well, if they don't do buybacks or dividends, are they actually accruing value? Like Lido has been accruing value to a treasury for like 4 or 5 years now, right? And they're one of the few protocols that actually moved their operational expenses under the DAO completely, right? And thus to the token holders. And very, like they were just a little bit too far ahead of that, their time there. And so it just hasn't really looked like values being accrued.
They also couldn't tell anyone about it, right? They couldn't be like, hey, look at this great thing that we've done to accrue value to our token.
Yeah, maybe. I don't, or they just like, took the path of, okay, if we're going to have a single asset that represents all interests in Lido and it's going to be a token, there's not going to be any equity, right? Then we're just going to shed all parts, all equity components, that touch the protocol and move them under the, the like, I don't know, the umbrella or governance of the DAO. And that is, I think, what you do want to do. And that's what we'll see going forward. I think that's what we'll see from like, the MetaDAO projects that are like actually doing this right from first principles from an early stage. Not speaking to whether
The
Futarki is right
MetaDAO's
at an early
such an
stage,
interesting
but
debate. I don't want to
yeah,
derail us too
exactly.
much, but
But no, but it is a reflection that and the revenue meta that, all of this is a reflection that we're just kind of like finally starting over, and trying to shed like the clearly like wrong lessons learned that turned out to be wrong, right? Because people stopped getting rewarded for like, these weird, dynamics where you could just launch a token, push out a narrative, and you would be like worth $5 billion. That's no longer the case, right?
But
So we have
it's a multitude of things though. To defend some of these teams, there was a very legitimate threat that you would go to jail if you did this the wrong way. That I don't think anyone on this call, I certainly, if we had been a token project, I wouldn't have been like, "Come get me! I'm going to do this the right way." And no, I don't want to go to jail, and I want to live in the United States, so I wouldn't have done that. So but I also think that opened the door to, I mean, just close your eyes and put yourself in the shoes of these protocol founders, right? I mean, oh, the lawyers tell me I have to do that or I go to jail, and I don't have to share any of these revenues because I can't. I mean, it's so understandable how it happened, and now you'll see the good founders move some of that. But here's an interesting thing that you wouldn't have necessarily thought. On top of not being able to have the correct construction, the narrative the the narrative actually fit this bad behavior in a way, and that's why you see so many teams push back on the idea that we might have to generate revenue, and they all wanna be valued in this special snowflake type of, and I like, arguably, like, Bitcoin did get that valuation, right? Like, that's the market has said, "You don't need to generate any fees. This is how we're
Yep.
bucketing you as gold." And so I think from a combination of looking at Bitcoin's success, literally not being legally allowed to accrue value or generate value in the other way, the narrative started to fit that reality. And and so now what a lot of teams, I have an enormous amount of empathy. They have these convoluted, complicated structures which don't make any sense, and they have to make legitimately hard choices. So to talk about Hayden Adams here, so Uniswap is probably the canonical example of, they had early product market fit, category lead, right? They've surrendered a little bit of that lead, but they still have this unbelievable brand. And, the front end was generating 200 million in fees. It would have been so easy to just say, you know what, we're not going to go first on this. And there were real challenges, right? Like they raised money in the equity entity, right? And they turned the $200 million fee switch to zero. I can't imagine what those conversations, that took bravery and guts, I think. And I would not underestimate, one, the combination of a bunch of people were hired onto these teams with the expectation that they'd never have to make any money. Like that is the legitimate on the ground truth. So think about how difficult that is to, undo from a team standpoint. Then you've set up legal structures with totally separate teams that might not even talk. I, I wouldn't underestimate the sheer
Yeah.
unpleasantness associated with unwinding these structures, and I think that's why it takes so long.
And I'm not. I'm more saying that like I don't know if it's that useful to be like taking in all those considerations to a forward-looking view of how to think about tokens because That is, there's so much contextual like baggage that just should never have happened. Like Uniswap didn't even want a token. Like SBF launched fucking Sushi Swap and forced their hand out of like a defensive move before they had any of this figured out, right? And so like, what can we learn from that? Like pretty much nothing, because that is not like the current circumstances on the field that like founders are dealing with. Now they can actually think about this stuff more from first principles. My guess is that we get some sort of like exemption period for these projects that will give them flexibility in the like early days, not to have to like play these decentralization theater games, and be able to operate like more, like a normal company, but also have a token. We'll see. Like there may be, we may be in a period right now where this is the only time that there's still gray area, like where you can just operate a token project like a company. We'll see.
Yeah. I
At
have a
least we
quick
get
comment to
clarity.
make here. In terms of like timing of all of this, like realistically, it was kind of when Trump got into office where a lot of the kind of buyback conversations started. And I think in terms of a team that has executed the best in the space that I think all of us are aligned on is like Hyperliquid. They kind of came out at the exact time when everything was more favorable to do these things like buying back the token and burning, etc. Before that, it was really unclear. And on top of that, Hyperliquid didn't really have this DAO structure that a lot of like the other kind of teams like Aave and Uniswap had. And I think with all DAOs, as we might explore at some point, there's a massive coordination problem. And so how do you go from like a utility or governance token to like a buyback and burn token or whatever model you choose that accrues more value to the token holder? That is really hard. You have to coordinate many, many token holders all at once, and you have to move everyone in this direction. There's a lot of politics involved with that. Hyperliquid came out with a clean slate and timed it really well. And before that, they were building, bang, more favorable regulatory environment, and they've been very successful ever since. The legacy teams in crypto, I think, have struggled more because, like you said before, Myles, which I think is a really good point, like Uniswap sort of was forced to launch the token in order to compete. I think what Uniswap is doing now to accrue more value to the token in the unification proposal, this is more of like an aggressive move in order for them to compete again with something like a Hyperliquid, because the financial market is rewarding teams that are actually accruing value back to token holders and not teams that like do not do that. So they have to do it. They have almost no choice. I think if Uniswap didn't do this, the token would continue falling and it'd almost be like trending down for as long as possible until they actually pivoted and changed their path. So I think in general it'd be interesting to see, like you said as well, Myles, like forward looking versus backwards looking. A lot of teams we're talking about right now in this podcast are teams generating revenue, which are legacy teams. There haven't been that many teams outside of Hyperliquid. Maybe Pumped Up Fun is another example of like they've just come out with no doubt baggage and just buying back the tokens, as much as possible. And you're seeing the financial market continues to reward this. So I think, unfortunately for legacy teams and DAO structures, they've got more to overcome and more challenges to get on top of, as opposed to like Pumped Up Fun, Hyperliquid, and probably future tokens that just go straight for the buyback approach. At least right now, that's what the market is rewarding. And the reason why they're rewarding it is because they want to see products and revenues and actual business models that make sense. I think this meme coin era really kind of like was the last of it for many people in the crypto space before regulations, when meme coins were just popping off everywhere. Didn't make sense. Like people were just speculating on the next coin with like no value accrual, no product, no nothing. It's kind of like in your face almost for Lido and Aave, where like they have real businesses but their token is trending down. Now having the opposite, I think like that pendulum is swinging, but it's going more back to the sort of DeFi native side where like buybacks and value accrual is actually now more important than ever because we can do it. So I think we should be doing it.
Everyone in crypto loves to talk about transparency, but would any serious business publish its payroll for the world to see or hand competitors its contracts? That's not a feature. That's a bug. And it's why most financial institutions can't operate on today's public rails. Canton Network is different. It's the only public permissionless layer 1 blockchain built with privacy at its core, sharing data only on a need-to-know basis. That's why Goldman Sachs, NASDAQ, and Broadridge are already building on the network. Only Canton delivers the network effects of a public chain with the privacy and control real finance demands. Learn more about Canton by following the link in today's show notes.
Well, okay, so here maybe we can start to talk about buybacks in this context. And I think that one of the things, and we're going to get into this if we have maybe some time, we can talk about futarchy, but I think one of the most challenging things about crypto from a mental model standpoint is we are combining the mental models of public market investing, where companies are primarily in their later stage by the time you've gone public, versus very early stage investing. And so one thing that I feel like I have consistently seen is this idea of, hey, we have these publicly traded tokens. We can take these mental models and frameworks that we have from investing in public market and apply them. And I don't think that that maps one to one. I think that there's the life cycle of capital investment and, return on invested capital that you want to see before capital is handed back to shareholders and the company statistically dies. And so I think that the reason, just because there is a reward for buybacks in public markets, which empirically exists, does not mean, I don't think, that you can copy that one to one on early stage private markets. And here's the analogy that I want to give you for, I've tried this on both of you already, so let's see if this resonates for the audience. But imagine you were trying to value two different boxes. You're like, and these boxes each do different things. In one box, you can put in $1 and you get $2 out, and it's infinite. As many dollars as you can find, you can give it to the box and it'll give you $2. How much would you pay to own that box versus a box where you put $1 in, you get $1 out up until $500 million, and then it just gives you your money back? I know that's kind of a silly analogy, but that to me is why, like, the reason why you get rewarded at the early stage of a business, the value you're creating, is being able to allocate capital at scale to get high returns. The reason Elon Musk is the richest guy in the world is because you can give him $100 billion or $200 billion and he'll give you 400 or 800. It seems to be almost infinite, right? Versus if you could give someone $1 million and they could give you 10, that's worth far, far, far less. And so I understand the reason why we want to do buybacks today, because we need to prove to the market that there's some value accrual here, right? The market's crying out like, please just, it's a low trust environment. We have so few success cases, but from a first principle I hate to use that word, but from a first principle standpoint, it's very hard for me to make the case that it makes sense for an early stage project.
No, couldn't agree more. It's like, first, stage one, make revenue. Stage two, like, make more revenue than you have operational expenses. Stage three is basically to, like, exhaust all reinvestment of free cash flow into, like, higher ROI opportunities. And then stage four is like, once you've gotten past that point, you have a surplus of, revenue that you think there's no, like, really high ROI opportunity to, like, put that to work, then you give it back to shareholders. And that's typically been the way equities have always worked, right? So I'd ask, like, Hyperliquid's the darling, right, of the market today. And a large part of that has been because they've won investor trust. And a part of that is because they have, been consistently doing buybacks and burns. Is there an argument to say that that's actually, at this point, kind of lazy, right? And that if you were, like, truly a long-term holder of Hyperliquid, you might wish that that team took in the couple $100 million of revenue that they're getting and invested that into turning Hyperliquid, allowing Hyperliquid to compete with, like, the actual, like, biggest incumbents in the world in 10 years. I don't know. I think
like, I totally understand where you're coming from, Myles. When it comes to crypto in particular, and also putting a spotlight on Hyperliquid, I just wonder, like, with the amount of money, the sheer amount of money they're generating, like, how could they even reinvest that into growth right now? I kind of think growth in crypto is capped almost at the moment. Like, we're trying to continue growing it. Talked about DAS earlier with institutions coming in. Like, if you're earning hundreds of millions in revenue per year, like, where do you even put that almost? And their team is so small. Like, maybe they could make some acquisitions or something like that, which I think could make sense. And I know they're trying to compete with Binance, but I also wonder if this regulatory tape is still something in crypto where if you grow too aggressively, regulators get fearful almost of what happened with someone like SBF and FTX. I don't think FTX was giving back too much in buybacks, although I'm not exactly sure what their token model was back in the day. Maybe they were. But I imagine that SBF was highly investing in growth and really aggressively and really got in bed with politicians and everything and did a great job and grew super, super fast. That's fantastic. But I almost think maybe in crypto, there's still a fear in the wider market of like a team that's growing too aggressively, too fast, reinvesting so much in the business, so much in marketing, so much in regulations and getting in bed with politicians, where it might actually not even be a great look for the industry in general. So like I'm actually quite pro buying back when it makes sense. I think with Hyperliquid in particular, it makes like a lot of sense, especially like right now. Their product has so much product market fit where theoretically they could always change it, and if they wanted to start reinvesting more, they could actually switch it a bit. There's a DAO now in Hyperliquid, so it's probably going to be harder for them to change their token value accrual. So that would be interesting to see if they ever change it. But it'll be interesting to see at some point if they do want to change it, what they then do with all of that reinvested cash, and if it's acquisitions or whatever else it is. But I think when it comes to something like an L2 or something like that, you're seeing a lot of examples right now of like layer twos maybe trying to buy back their token and it has no impact. Well, that's because if there's more emissions and buybacks of the token, then of course that's not going to make any impact whatsoever. And unfortunately in crypto, most teams have way more emissions than they do revenues. So like there's no way that buyback is going to make an impact. There are very few teams where they do have more revenues than emissions. And I think those teams are more mature anyway. They have product market fit. And so I think because they are more mature, they have already invested a bit in growth over time and they are already successful. I think it actually does make a lot of sense to buy back the token and accrue that value to token holders.
I think it's fair. On the emission side, like that maps over to equities as well, right? Like Coinbase gets hammered by Wall Street for, their stock-based comp. It's just, much higher than their peers. And yeah, I do think the counter argument to my steel man is like Hyperliquid has operated with an 11-person team or like whatever it is. It's tiny, and that's how they're really good at that, and that's what's been working. So why would you go and like create a massive organization, through hiring spend and lose your edge? So like I think that's all very fair. Now, like, should they have invested in a Super Bowl commercial like Coinbase did? And maybe that's where like, yeah, like that would get the regulators a little nervous. And I think that's yeah, go for it, Mippo. What are you showing here?
I think there's good steelmans for both sides of this argument for what it's worth. And I'm showing, this is unrelated to crypto. This is AI related CapEx, as a percentage of, they're showing it as a percentage of GDP and the total raw amounts here. So in buyback land and equities for a long time, there was an almost moralistic argument around buybacks, which is American company CEOs are not doing their job. The job of a CEO is to find those organic opportunities where you can invest capital and get, a return on that above the cost of above your WACC, your ROIC above your WACC. And instead what they just did is they bought back their stock, right? And there were these crazy incentives, right? Because they mostly have stock-based comp, but there was this attitude that you CEOs are not doing your job. And what the CEOs said was, there's nothing good to invest in. And if there was something to invest in, we'd invest more. And the reason I'm showing this is because I think that actually is kind of proven out true. As soon as a great new technology came along in the form of AI, these companies massively increased their CapEx and their R&D and all of that stuff. So it is true that opportunities to invest at scale are not even. They're not evenly distributed. And it could be that there aren't opportunities for a Hyperliquid to invest right now. But where I would push back, Xav, is often there's and I feel like it's mostly a criticism of like young teams and investors that are worried about empire building. And they say, well, we don't want you to allocate that. Like, we don't really what I hear in that is, we don't really trust you to find these opportunities. Like, I don't really want you spending on this. Just give it back. Just give it back to me. And what I would say is, I don't think that, to me, is kind of, sorry, but it's kind of what I hear there is kind of like skill issue. Like, I kind of refuse to believe that there's nothing that Hyperliquid could be doing with that capital that wouldn't be better off, right? Like, yeah, I mean, getting potentially regular, like, and again, this is where I can argue both sides. It's very possible that it's not. It's just, 80-20, I'm like, there's nothing you could be investing that money in. And again, when you go back to the box, what I would say is, and this is one of the this is just, I just fundamentally feel differently than everyone apparently. If the 11-person thing is great, if you have the infrastructure to reinvest capital at scale. But I would say if you don't have the internal, you know, bandwidth or talent or whatever it is to allocate that capital, get more people so that you can allocate the capital better. I mean, that's, to me, that's kind of like, it's kind of what I hear a little bit.
Yeah. With Hyperliquid in particular, and yeah, great graph, Mike, and definitely understand where you're coming from. You could make an argument with Hyperliquid around sort of ecosystem development and using incentives to get more builders in the ecosystem. It's really about competition, I think, with someone like Hyperliquid. What is Hyperliquid competing against? Well, perp dexes, of course. And so they could be reinvesting to try and build better moats, either via integrations, etc., with different players, which I'm not sure exactly to what extent they've already done that, and maybe they've already maxed that out. Another thing they could be doing is focusing more on spot market if they want to compete more there, which is definitely another argument to be made around what they could be doing. Obviously, geographic expansions into certain countries, for example, where they actually might want to end up competing with the SEX. I think there's a question around the growth strategy in general of Hyperliquid. Like, what is Hyperliquid in 5-10 years' time? I'm actually not 100% sure. Is it like the world's biggest exchange? Well, if it is, probably they should be already investing in growth and maybe like limiting the buybacks. If it's like the biggest perp dex in crypto, which is already a big market in itself, and maybe they've already found product market fit and they're happy in that lane, okay, maybe the buyback does make sense. But I do think there's obviously room for growth in Hyperliquid if they wanted to use more of that capital to actually grow the business, even maybe like an insurance fund in case it all goes wrong or something like that. There's like many things you could think of, but yeah, maybe it's unclear to their team right now, even what that strategy looks like. And it might be a watch and wait. They've had a lot of success in a short amount of time. Like maybe we're speaking too early and they might actually end up growing their pie at some stage, but that'll be
Yeah.
very interesting to follow.
I couldn't agree more. And like going back to the point of just us carrying so much like baggage that's should be irrelevant going forward, like it would represent an identity change, right? To Hyperliquid if they were to say, guys, we're actually going to decide to keep this revenue and we're going to allocate it into growth. And maybe they've earned enough trust, with the market at this point that that would be totally fine, right? But there's not many projects that can kind of say the same. And so yeah, I think like all of this sort of like muddiness will go away once if token holders just trust the teams to invest the capital in their best interests.
Yeah, and these things are difficult. I don't think you can do one size fits all. I will say in maybe 98 out of 100 scenarios, it probably is just best. You hit this gusher of cash, right? Maybe just give it back. Maybe just give it, maybe you hit this gusher but the reason why Mark Zuckerberg is because he found creative opportunities to allocate that cash into Instagram and WhatsApp, and those are some of the best acquisitions in the history of finance and business. So, my honest reaction when I hear some of this stuff, I think what tends to happen here, I think what people are reacting to that I have a lot of sympathy for, that at least I've seen, is hit a cash gusher of some form, right? There's an enormous amount of pressure once you make money like that to put a bunch of process and people, and we should do marketing now, and you probably hire a bunch of like middle manager types that don't actually do any, and we should be doing ecosystem incentives. You probably don't need ecosystem incentives. I'd say that I would kill incentives in general, but I think that again, the devil's in the details and execution, because a young Mark Zuckerberg found an opportunity, right? And he allocated capital incredibly, and it saved and made Meta what it is today. So I don't know what that is, but I would say that that's what you're paying a CEO for. And partially this also comes from, I'm just not bullish on this idea of one-man companies. I'm not a bull on this idea because there's a question that a guy from Bailey Gifford used to ask, like, why are cities so much more enduring than companies? Like, why is a city so much more enduring than a company? And I think the reason for that is the amount of people that you can get on the same wavelength ends up being highly durable. And so like some of these companies like Tether, Hyperliquid, we'll see. Like I think Tether is the one glaring like, well, look at Tether, and we'll see. We'll see if it's able to enter the institutional like one other way of saying if Tether wants to enter the market of the United States, suddenly it's going to have to hire. It could go from, oh my gosh, look at how successful they are with 70 people to holy shit, they need to hire 500 compliance people overnight. I don't know. That might not be the case with AI. I don't know. But in general, there's something instinctive that I'm just not bullish on these. The future of companies being 10 people, I'm not bullish on it. So
Yeah, I think I'm taking the other side there, Mike. I'm incredibly bullish on solo founders. I think we're in the very, very early innings of that. We should definitely explore that in one podcast because I think that's something that I'm noticing in the venture landscape right now. I'm speaking to way more solo founders, which I think are better chances of making it and move a lot faster than ones in small teams. But outside of that, I want to take it back to the buyback kind of pros and cons. So, we came up with a few points pre-podcast on the kind of bear case for buybacks, and I think some of these points are worth mentioning. There's one like exit liquidity argument where buying back can provide a bid for insiders to sell into, especially when combined with ongoing vesting and unlocks. And there's a question there around like, are you buying back as tokens emissions are going live, and obviously they get a better sort of thing to sell into, and maybe it's actually not the fair market price, and you're kind of like actually making that like again artificial. Some other 2 or 3 more arguments. So CoinGecko, this is CoinGecko data. 14 out of 23 major buyback programs have only repurchased less than 1% of total supply. So like, I think buyback programs outside of Hyperliquid, like sometimes they're just marketing ploys almost. Like they're saying they're buying back the token, and people buy the token thinking that the token's going to go up, and like actually it makes no impact whatsoever. And I think a few examples of this, one, Helium, they actually came out in January last month saying that they spent millions, but there was basically no impact, especially on the token price. And now they're going back into growth. And two, Jupiter, which I think is also interesting. They spent a bit more on buybacks, and unfortunately, they had a lot of token emissions, and so really the buybacks couldn't absorb that supply going into market. And now, from what I understand, I don't think they're doing that anymore as well. So there is some pushback. Pump.fun as well. I don't know the exact numbers, but I don't think that they're holding in terms of like they've made a profit on what they've bought back. I'm pretty sure they bought higher. Now a lot of that is in loss. And then, finally, I guess one of the protocols which we haven't talked about very much in this podcast, which I think does a good job, which might be worth exploring. And I know, Mike, you probably spent a bit of time on this protocol in the past, is actually like Sky, previously Maker. I think they've done buybacks for the longest time, and maybe really could be the shining light in what does work long-term in crypto. I think they've done a great job over time, and maybe not talked about enough in this conversation. So but the other ones I think have all underperformed in their like buyback of the token. So maybe Sky is the one that we should be looking at in terms of what actually makes sense long term.
2 other points to consider. One, I will also grant that there is a reflexivity feedback loop in crypto that might be stronger even than in equities, where the price of the token going up is amazing marketing. And it's possible that buying back the token to generate number go up could actually lead to a huge influx of genuine organic business activity in a way that I'm not, George Soros has talked about reflexivity in finance, but I think it's even more souped up in crypto than it is in equities for whatever reasons.
I mean, with Sky, like they had like fundamental investors, VCs buying liquid tokens in size in 2021, 2022. This is when it was Maker. Because the upside was just so massive, right? This was literally, literally had a chance to like get a piece of what could be one of the biggest, decentralized currencies and banks, in the world. And I do think they've done a lot of things right, but the token price not reflecting that is more a reflection of like all the craziness of, the end game. And frankly, like the growth prospects for the future kind of being reevaluated, and being much smaller than what was originally like envisioned. Right. And I have no idea if those investors are still holding at this point. They might as well, or maybe they've like sold, but I think it's less about looking, like all of that stuff is not visible to the public necessarily, but you can kind of glean it from just following the project as if you were like an investment analyst. I don't think anybody was like hugely bullish about like the end game and then all of the governance drama that went on there. Like it just hurt basically the reputation of the project and thus the asset. But yeah, I don't know. That's my fundamental view. Maybe I'm
Yeah.
curving it.
No, I think you have a good point there, Miles. I think in general, you're seeing right now, again, like the financial market wants teams buying back more than ever. Then there's a question around like the actual sustainability of the revenue. Is it genuine, etc.? Projects like, Sky and, others, Aave, it is actually sustainable and genuine, and it is kind of like mature now. I think the question is really like, if you have a token now, like how are you thinking about it? Because I think there's a real risk to founders right now coming out to market being like, you're seeing these success stories. It'll also be quite interesting seeing Polymarket token. I think that was announced very recently. I've got no idea if any value accrues back to that token or if it's going to be more like a governance token. I've heard in the past it's more of a governance token. So that could actually completely unwind a lot of this conversation and maybe hint more towards the governance token sort of side. Also, interestingly enough, this ties back into a podcast we did a few weeks ago, which is the token versus equity and where value accrues. I think like this conversation around buying back for the token, unification proposal, DAOs, like operational expenses being paid through DAOs instead of through companies, etc. Like these are all sort of blurry still, I think. Like some companies have equity and token, some just have a token. And I think a lot of the buying back is trying to make the token behave more like equity. Whereas like, I don't know if there are any examples right now that exist where both the equity and the token are trying to behave like equity and buying back and how that revenue is distributed across both equity and token. But I think there's just no perfect model. So in general, I think last year, like the space did mature. Institutions are here. I think everyone in crypto admits that crypto is now a more mature asset class. Like I would sort of make the statement that like there are less high growth things, at least right now. I think they'll be built like very, very soon in this upcoming cycle. But right now, a lot of the tokens that are working, we already know what they are. We know how to value them. And especially not just us, but institutional investors know how to value them. Think back to like 2017 cycle when all these utility tokens were popping off, like they were just retail people buying it off like a Reddit post. I don't think they were doing their DCF models and being like, what does this actually mean? And like, how do I actually value this? Now it's like 2026. I don't think the retail on Reddit is like coming in to buy like the next random coin. It's kind of like institutional investors that manage funds that need to tell LPs why they're investing in something. They're doing massive analysis and financial models into like why to buy something. And I think it makes their life very easy if you're just buying back the token as a way to actually model that. And that's why I think a lot of teams are moving in that direction, as opposed to like something where they're not buying back, they're reinvesting in growth, because there's still like a massive trusting in crypto, which I think we're still learning about. We work in an industry where the technology provides trust. Yeah, I think that a lot of people in the industry, maybe we don't have that trust in those people yet to actually believe that they're always going to take the right actions with that capital. And I think maybe until that trust is earned, it might take us a bit longer until everything is just
I guess that like that's to me kind of a I agree with that logic 100%. That's just kind of bearish tokens for me, because that's just like a drag on your cash flow, right? Like if you just literally think about what it takes to operate a business, if you're allocating, it's like a tax every year, right? Just I got to prove this to the market, so I'm going to spend 25% of my operating income buying back my shares.
Doesn't this get kind of solved by the introduction of like right now we have venture investors and we have retail investors. And for years we've been saying we've been missing, the institutional liquid investors.
Hey, BlackRock bought
right?
Uniswap today.
Okay, great. Well, like they're not holding widely diversified portfolios of like alts, and like app tokens. Some are.
No,
but
no,
it's
no,
been a
not at all.
fucking nightmare of a business to be a liquid token investor. Like it has been tough for years, right? And that to me is like it's a very important, critical missing piece, because like that just if a lot of investments into tokens in the future are going from retail giving money to an asset manager and the asset manager making decisions of what tokens to buy, like you can get stickier investors is I guess what I'm saying, like longer term investors who aren't going to be as emotional and volatile about like I don't trust you guys, I need money back right now. And it's going to be investor relations will be a lot easier for the protocol, like, teams, right? Because they'll just have fewer, people that they need to like talk to appease. Of course, like direct retail investing is like what I think, and holding these assets directly in a self-custody way is like the promise of crypto generally. So that will never go away. But I do think like, things have just kind of gone like they're just way too emotional, way too volatile, and like the lack of trust is there because retail is for the most part very uninformed, and like there is no transparency, like, and there is no investor relations functions really. And it's really hard to like defend capital allocation decisions to like hordes of angry Twitter anons. Like you are going to screw up if you're not like occasionally on a capital allocation decision. And if you're not like giving back dividends or doing buybacks, like, going back to Facebook, like the whole metaverse thing didn't really play out, right? They made the bet on VR when they should have made the bet on AI. And people are not like screaming for Mark Zuckerberg to be fired. But yeah, I don't know. I do think a lot of this gets easier with that, market participant, actually coming in and staying.
Definitely. I think the BlackRock Uniswap news is like literally this podcast in a nutshell. They're buying a token that is now accruing value directly back to the token, which in the past was just a governance token. And maybe that's the reason why they didn't buy it all those years ago. So you're literally seeing the institutional market is rewarding this in terms of like, buybacks, revenue, value accrual. So I think this trend is going to keep continuing. I might pose this question to you, Mike, as one of the last questions in this podcast, which would be like, has there been any team which you think hasn't bought back the token, which has done a really, really good job at reinvesting into growth inside crypto, like a protocol or something like that, where they've grown like a massive amount from not buying back the token, but actually from reinvesting into growth?
I think Morpho's done a good job.
Go on. I mean, I think Layer Zero has clearly done a good job.
Like that's
they spent so much money on R&D, and now they have or at least an L1 that's actually like somewhat differentiated. Looks a lot like Delco, but very differentiated. So like that's an example. And if you noticed yesterday, they got Cathie Wood to go and say we bought this token, and they said they got Citadel to say we bought this token, right? And that is like a high leverage way to instill like trust with, by the transit of property with investors, retail investors who already trust and respect those, institutions that are buying it.
Yeah. And I mean, I would also say all of the centralized exchanges. Like, I don't know. I mean, I see everyone showing like the Hyperliquid versus Coinbase chart. I could eat these words. This is not something that I have a super strong perspective on. But I think there are more examples than you might think of, but they're mostly companies that have done this. They're companies and they're not DAOs.
It's really hard to do this in a DAO structure. I've run those grant programs. I've done the BD. It is really, really hard. And back in the days where we thought we actually had to have DAOs for regulatory reasons, where everything was going was something that looked more like, corporate equity governance, where token holders are delegating decisions, right, further and further up the line so that, you can be nimble even in a DAO structure. Maybe that comes back if regulatory, clarity does say like you do need to have one of these DAO things. It's like, okay, well, we're not going to, do the token holder voting again. Let's just pick back up where like we were kind of headed on that DAO path. But yeah, I think it's challenging.
Yeah. I don't know. I think in the world, I think it's a consistent belief, by the way, is they have to say like, if, in this world of if there are a very small number of people, that are able to generate billions of dollars consistently, I think that when you're in there's also part of the story for me, right? Like when I think logically about the whole life cycle of a company, right? Like the way that I think about it is when you look at what's getting all the investment right now, just think about the story. I think, why are all these AI companies getting a gajillion dollars of investment? It's not like anyone's putting numbers. people aren't investing in AI because they're like, oh my God, these numbers. I mean, they're showing great numbers too. But it's because I think at the early stage of equity, you want to hear a great story. That's something to the effect of, wow, big problem. Oh, really complicated, hard to solve, huge, undefinable market, win it. And like, that's a better story in the beginning than here's a dollar amount that I'm going to, in the later stage of investing, once the market has been proven out and people do have a rough sense that you could back into how big the market is and what the profit pool looks like, then you want to see actual dollars and real statistics you can back into. And how many dollars am I giving you this year? It's a misfit for me. Unless you're, but again, the way that I square the circle is unless you're at a really, unless actually you're about, this is your market, unless I'm looking at your market right now, right? In which case there's not growth. There's like,
Yeah.
that's where I'm, that's,
But that's a good point though, Mike. I think like crypto versus AI right now, AI is growing massively. There's huge amounts of adoption. It's taking over the world. Like crypto needs more growth and more adoption. I do think actually right now crypto needs this extra leg up, and I think a lot of projects and protocols, unfortunately, right at the moment, some growth is capped. And I do actually think teams like Morpho, like you rightly mentioned, Mike, are doing great jobs reinvesting capital and like actually getting distribution. Like teams now, the constraint in crypto is distribution. So if you're going to be reinvesting the capital and growing, you need to be reinvesting it in that, I think, more than anything. Maybe some UX as well. If you're reinvesting it into like incentives where like capital is mercenary, you get like short-term TVL, like historically, this is what it's been reinvested in. And I think that's not really working anymore. We need to do a better job of growing and growing not just the protocol itself, but then the industry itself. And I think AI, yes, people are investing in this right now without expecting any value accrual or buybacks or share repurchases or whatever, because it's growing so much. And like the long-term outcome of that is so huge and the TAM is so massive. In crypto, I think we need to expand the TAM. That's what the industry is crying out for right now.
Yeah. And the challenge is like, I think the market is looking at crypto's TAM having like, gotten smaller since maybe 2021. We looked at like, is read write own thesis, is that still, valuable, or is it really just an asset? These things are asset ledgers that are good for payments and, trading.
That should be a podcast episode, actually.
Yeah, for sure.
well, last question for you guys. What do you think about, how would you, so here's another, usually what people talk about when they say what makes a good token, they're looking at the tokenomics, and it's the division of how many tokens should go to the VCs versus the team versus the community. How do you think that should change going into the future, if it should change at all?
100% to the VCs, if you can. No, I think like you just want fairness and equity. Like that's really the goal that every team should be striving to achieve. And I think the team should feel like they're incentivized with enough of a portion of the tokens where they feel like they're fairly compensated for their work. Investors should feel like obviously they're taking the risk and they have enough ownership for the risk they've taken. And, I think in the past, I do think like 50 to 60% to investors is too much. Like there has been some projects like that in the past, which have given out that amount of tokens. It's a completely separate question altogether. I think like a third to me seems kind of fair. Like a third investors, a third team, and a third community, because they're like really the key stakeholders in any startup. I haven't explored this like very, very deeply in recent times of like what's actually the status quo, but yeah, again, I just think it's important to reward everyone contributing to the project early. But community as well is, I mean, this could be a podcast topic in itself. Like, how many tokens do you airdrop to community? Like, Hyperliquid obviously did another amazing job there. They bought back the tokens, but they actually got the people with the tokens in the first place with the airdrop through distribution. So it can be a great distribution strategy if people are aligned and hold long term, but also obviously they can dump. And then if they dump, the token price goes down, the team loses hope, investors start dumping. It's like a virtuous cycle, talking about reflexivity, Mike. So yeah, I don't think there's a perfect answer to it right now.
I mean, will there even be 3 buckets? Like if you think about what does a community mean? Like that is for the most part the same function as the VCs. Like people give you cash, right? You give them this asset, assuming when we say community, we mean like for the most part public sales, right? And if the investor market just actually trusted these teams from the beginning, if we didn't have all this scar tissue, like it would be a lot more, you'd have a lot more flexibility. You could do a public sale early on alongside maybe, after a private VC sale to like actually build the product. And then you can hold back, an amount that you can then decide, okay, should we go sell this in a future public sale, or should we, sell this to private investors? Like the airdrop piece is the only thing that's a little bit different in like what you pay out in incentives. But I think it's crazy that like we make those decisions before TGE, like, and they're kind of set in stone forever. Like, um, you know, equities don't have to do that, obviously. So yeah, I don't know. I see this all just getting a lot more simplified over time.
I think I would encourage founders, if you're launching a token, to so one, I think that giving tokens to the community doesn't make any. I would just kill the whole airdrop meta. I think you're just encouraging sell pressure. Now here are the big differences. The big exceptions to this are like Bitcoin to an extent, Ethereum, Jito got the benefit of this with an amazing airdrop, Hyperliquid. I would say there are examples that fly in the face of this, but what I would say in general is that it's been overall massive net negative for the industry. And I think that if you're going to compensate, what it also allows you to do is, anyway, there's a bunch of issues with that. I just don't think the juice is worth the squeeze. I would just compensate your own employees more highly. I think there's an interest. Just the playbook needs to change, right? Like, I think I feel the same way as you guys. Like, I kind of feel the pit in my stomach when I see protocol launch, and it's like the market cap is, 15% of the FDV, and it's like, great, this thing's just going to go down for 2 years. I mean, so generally, this works in equities because actually the amount that gets released, that gets put into the circulating supply, the amount that gets put into the circulating supply is like roughly equivalent to like when you the amount that gets released when you IPO. The difference is those businesses are far more mature. So what I would say is one of two things needs to happen. Either we need to wait far longer for the token to go live, if you want to keep the supply, the amount the same, or when you go live, I think actually I'm kind of moving more in the scale of like, just get the unlocks out of it, like release a greater amount of the supply so you have a lower, because what you're trying to do is engineer the token to go up, right? So if you went theoretically live, I'm talking out loud here, which is really dangerous to do, but like, let's just say you went live with 100% of your token supply and it bombed, it would be up only from there, and that actually, you might get the benefit of getting people who bought in then and go with you. I don't know. But whatever, I would just say that whatever the current status quo isn't working. The most obvious thing to do is wait to go live with your token later. But I think it would be a net good for everyone. Like, again, I've used this statistic on here. Dell IPO'd at $150 million market cap. Like, that is a net good for society if we can get. I think it sucks that you wait until a company's got $1 billion of ARR before they can go public these days. Rant over. But I think I would just change the playbook, because what's happening right now is not working. I'd say. All right, gents.
Agreed.
I think we've any stones left unturned here.
On that note.
On that note. All right, guys, this has been a really fun one. Hopefully we have defined what a good token is, and I'm not sure we answered the buyback question, but I think we had a good debate. So listeners can make up their own mind, and yeah,
Keep it simple. If you're the project, focused on the product. If you're the investor,
KISS. Keep it simple, stupid. Great advice.
and actually look at lessons that we should be like applying from the past, and try to delineate those from the lessons that no longer are applicable or were just bad lessons to learn in the first place, right? So yeah, I think it will be better going forward. I don't know if allowing your investors to like liquidate the treasury a day after you launch a token with Futarki is like, actually, that just sounds so fucking stressful as an operator. But maybe we can cover that, at a different time. Probably in a whole
I guess
episode.
this is a kind of a funny way of describing this, but how do you engineer? Because there is some amount of engineering, I believe. How do you engineer making the token price go up? And whatever we're doing right now does not work. Like it obviously doesn't work. We're engineering them to go down. So it's difficult. I don't.
I mean, I think for the token price to go up, you have to have a good business and a good product, and people actually need to use it. That's my take there. And I think in crypto, there's not enough of this, and we need to experiment more.
It needs to be
innovate.
all of it though, right? Like it's all of it. I think that even if you just had a great product and a business, you still need to like advertise. Like Jim Perillo came on this podcast a couple years ago and said this, like as soon as you launch a token, you have two products, your product and your token. So I agree. 80% of it is just a good product that people want, but there is some dark arts like engineering buyers and
I used to definitely align with that thesis. I think that the token is no longer the product. I think if teams are spending too long thinking about making the token the product, they're going to lose out the gate. You need to make the product a product, and the token, I think, should be following
this
after
is
that.
a super interesting though. This is a very interesting difference too in between like public and private market invest, because when you're a CEO or a CFO of a publicly traded company, you absolutely need to spend your time on the stock. Like you can't just be like, hey, I've got a great product that's killing it. You need to go and spend time, talk to sell side analysts, talk to buy side analysts, bring people along. Like you need to sell your product and you need to sell your stock. And I don't know. I think we've flip-flopped a lot. We're like just we did too much dark arts, right? And now it's like it has to be the product. And I agree it has to be the product, but in a stable long-term equilibrium, I think it's both. Anyway, all right. We got over an hour here. All right, guys, this was a really fun one. Appreciate you both. We'll see you next week.